is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Inflation angst fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke join the chorus of caution. The BOE steps up its bond market intervention this morning. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens more attacks. So first thing is first, let's check on the markets. Stocks fell, definitely pressured by rising treasury yields and signs that company earnings will not be as good as expected. We've seen already a couple of disappointments when it comes to earnings, certainly when it comes to chips, and also a gauge of dollar, which we'll get to in a second, climbed to the highest this month. Now, European shares overall are down. We have S&P futures, also a bit of pressure, but if you look at the European stocks, they're also declining for a fifth straight session as bond yields jumping. Again, the persistently higher inflation is what people are concerned about, as well as the impact of hawkish central bank policies and global growth. Then watch out for gilts, the 30-year. Look at that, 4666. The personal thing that people are worried about is, of course, the Bank of England will have to do a lot more. This is the third time that it intervenes on the markets, with now widening the scope of what it could buy. But the question of timeline is extremely important, as it's unlikely that the markets will like if they start QT later on this week. And then the other big question is, of course, do they need to continue buying bonds into that November 3rd Bank of England decision, and how aggressive will they be then? So I don't know if we have a European map. Maybe we do, maybe we don't. If we do, it's a good time to show it. And it's really a sea of red across the board, with the FTSE down 0.7%, FTSE MIB down 1.6%. So as we were saying, global bonds selling off on fears that U.S. inflation numbers will bolster the Fed to continue hiking. Now, this as the Fed's fight continues. The heads of the IMF and World Bank are also warning of a rising risk of a global recession.
There's the risk and the real danger of a world recession next year. The advanced economies are slowing in Europe. The debt levels for the developing countries are getting more and more burdensome. The rise in interest rates puts added weight on it. And inflation is still a major problem for everyone, but especially for the poor.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be, between now and 2026, $4 trillion. This is the size of Germany GDP gone.
Well, we're joined by Deirdre Cooper, portfolio manager at 91, and Christina Kino from our markets team. So thank you both for joining us. Christine, let's start off with you. When you look at the anxiousness on the markets, it's again, when will the central banks pivot? And it doesn't look like they're ready to pivot yet at all.
Absolutely, Francine. At least when it comes to the Fed in terms of its tightening policy, we definitely see a lot of camps arguing out there, Goldman being one of them, saying that it really is too early, especially given the tightness in the labor market in the U.S. and the fact that inflation is probably still going to be sticky at these relatively high levels. We'll probably get confirmation of that, of course, this week with the U.S. CPI figures. And yeah, I think it really has been the priority of the Fed to tackle inflation. Although I would note that we do have Lael Brainard now starting to kind of sound out the potential impact, right, of a tighter Fed policy, how that flows through to the global economy in terms of weaker demand, and then how that in turn impacts the U.S. economy. She is, of course, a known dove, so not quite the consensus view, it doesn't seem like, at the Fed, but something to keep an eye out for.
Yeah, certainly to keep an eye on. Deirdre, overall, how much can the central bank support markets right now? And if they can't support them because they don't want to, or just it has to play out itself, what should traders be doing?
So I think we would agree. Our base case is absolutely that the Fed will stay the course. That means a choppy couple of months for markets. It also means our base case is a recessionary scenario. And what that means for us as active fundamental investors is that we have to find those companies that are more resilient, that have pricing power, and that can thrive, or at least, perform better through that very choppy environment.
That's hard, Deirdre. I mean, when you look at earnings, probably everyone will be tested. Where do you find that value?
No, that's exactly right. So we are going through all of our, company investments, looking at our forecast. We do see areas where companies are much more resilient. I think this is an unusual scenario where certainly in Europe, you may have a high energy price recession. And that means that there are parts of the market, companies that are the solution providers for energy efficiency, perhaps other parts of the sustainability universe, companies that are providing increasingly cheaper alternative power sources to more expensive energy. All of those companies might perform quite differently in that recession.
When you look at some of the movements, not only in gilts, but in bonds overall, I don't know, it's impossible to find a floor, actually.
Yeah, it really does seem like that, doesn't it, Francine? I mean, the UK, of course, is its own very special case. Again, we have the Bank of England itself saying that it is afraid of the risk of a fire sale, its own words, in the UK bond market, and that's why it's stepping up its measures for a second day in a row. But more broadly speaking, I mean, it makes a lot of sense, right? The yields keep going higher as a lot of these central banks continue to telegraph more rate hikes. You do, of course, have camps now coming out and saying, well, actually, bonds are attractive. We know we've been talking about this, PIMCO, Bill Gross among them. But again, it's a question of timing this particular trade, right? I think, it probably might make more sense if that trade comes through perhaps in 6 months when markets are expecting the Fed funds rate to hit its peak, at least it's based on current pricing. And then that might be really when that sort of bond bullish trade pays off. But at the moment, it really doesn't seem like, it feels like a pain trade, really, for a lot of these bulls.
Yeah, and I guess, Deirdre, the question is, why do markets not quite believe that central banks will be as aggressive as they say they will be?
Well, I think it really depends on where you are. I think markets generally, as I said, in the US, if those of us who are reading the Fed commentary, we believe that they will stay the course. I think in Europe and in the UK, it's a lot more difficult. Investors want credibility and visibility. I don't think you have either of those things at the moment here in the UK in terms of fiscal and monetary policy, and it's going to take time to regain that credibility and visibility.
Deirdre, thanks so much. Deirdre Krupa, their portfolio manager at 91, stays with us, and Christina Kino from our markets team. Thank you as well. Coming up, the BOE widens its bond buying. Lawmakers return to Parliament later for the first time since Kwasi Kwarteng's mini-budget wreaked havoc. That's coming up next, and this is Bloomberg.
I worry they haven't done enough, quite frankly. I mean, what we saw yesterday was an extraordinary move in gilts and ridiculous move in index-linked gilts. Yeah, you've got a real spiral here. I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
Well, Alan Higgins, Chief Investment Officer at Coutts, on the Bank of England's intervention in the gilt market. Now, the BOE expanded its bond buying after UK bonds sold off again yesterday, led by inflation-linked notes. The Chancellor, Kwasi Kwarteng, meanwhile, is set to present revised fiscal plans on October 31st. His second attempt follows a package of unfunded tax giveaways that sent markets into a tailspin last month. Now, joining us now is Dan Hansen, Bloomberg Economics senior UK economist. Dan, great to speak to you. When you look at what the Bank of England has been trying to do, so this is the third time that they've intervened or winded the scope of what they can do. How much more will they do to stabilize gilts?
Yeah, well, morning, Fran. I think that's a really interesting question because we've got this October the 14th deadline, the Friday this week. And I think the bank's in a real bind because it keeps intervening and it's being very reactionary at the moment. And I think what markets are looking for is a little bit more certainty and a little bit more certainty beyond this October the 14th deadline. And I think, if you're looking at it, it seems more likely than not there's going to be at least some sort of commitment from the bank to say, look, we're going to be here if we get another flare up. And I think probably at the more extreme end is that they sort of back up and say, look, we're just going to stay in the market for longer. And as you mentioned there, give Kwasi Kwarteng time to set out his fiscal plan, which we know we're getting on October the 31st now.
But Dan, if you think they need to persist with the backstop, right, for another 2 weeks, maybe, dovetailing into that November 3rd meeting, which is also the point that Van Ram is making on the blog today, then why do they not do it now? I feel like it's trickle, 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 or third time intervening, and the markets are just testing that. Yeah,
I think that's right. I think there's a really good question there about why they haven't decided to say, look, we're just going to stick this all the way out to the end of October. And I haven't got a good answer for why they aren't doing it, because it's very clear that the market is very jittery. There's a lot of uncertainty there. And I think, you know, they're just going to have to do something to bridge this gap. And fundamentally, it is a part about bridging the gap. Ultimately, this whole question about credibility and this broader question is on the government, and it's on fiscal policy. So the bank has a role in this, but ultimately it's not going to be the answer. The answer lies with fiscal policy.
So, Dan, when you look at how much the Bank of England needs to raise rates by, I know the market's probably pricing in 100 basis points. Does that seem too much or too little?
So I think for the November meeting, there's a really strong argument for them going big. The big fiscal stimulus is essentially a free swing for them. And I think we're penciling in at least 100 basis points. What they'll be watching as well for this meeting, and what will be really important, is what Kwarteng says on October the 31st, and how much he offsets the fiscal easing of the tax cuts with spending cuts. What I think further out, though, is that the market's probably getting ahead of itself. We've got market pricing at around 5.75 or 6% here in the UK for the peak rate. I think that's too high. I think the bank's going to be very worried, probably when it gets to about 4%, which I think is likely. 4.5% seems like a reasonable bet for me. Once you get to that level, the bank's going to be very worried about recessionary dynamics and also about the impact of high rates on the housing market. And we're already seeing the increase in mortgage rates and how that's affecting people's income. So I think those two things are going to stop it out a little bit lower than markets are currently expecting.
Dan, when you look at, of course, the fiscal spending, and we heard from the IFS, very respected institute, saying, look, they need to find 60 billion in funding, basically in austerity. The government needs, so it's now a choice between whether they go ahead with their plans and where they can save. Is that the kind of figure you're also looking at? I know that the situation changes every day, and we have some really great analysis at Bloomberg Economics.
Yeah, I mean, you're right. It does change every day. Every time interest rates change, the target changes because it changes the amount of debt interest the government has to pay out. But I think the IFS is about in the right ballpark. About £60 billion looks to put debt on a downward, the debt burden on a downward trajectory, a sustained downward trajectory. About £60 billion looks right to us. I mean, the challenge for Kwarteng is finding that. Of course, we've had austerity over the 2010s in the UK. It strips so much out of departmental budgets that he's going to have to look across departmental budgets. He's going to have to look across benefits, but also potentially across investment spending as well, to make the sums add up. And even then, it looks like a stretch. So you can't help but feel that there's going to be a question around tax as well. Potentially not the tax cuts that were announced and reversals there and U-turns, but potentially tax increases elsewhere, because the scale of what needs to be found to make this add up is enormous.
Dan, thank you so much. Dan Hansen there, Senior UK Economist at Bloomberg Economics. Now we're back with Deirdre Cooper, Portfolio Manager at 91. Deirdre, I know we talked, big picture about the UK gilt market, but in general, what do you do with UK assets?
Look, I think I would absolutely agree with Dan. It's a very difficult situation here in the UK. But to your question, that doesn't mean that it's a difficult situation for every UK listed company. So there are lots of companies listed in the UK who really are global businesses, who potentially benefit actually from a weaker pound. And we see some opportunity across our UK equity funds to invest in those companies at really attractive valuations.
I don't know whether, I know you also look very closely at sustainability, and there was maybe 14, 18 months ago, there was a belief that the UK, because of its change in stature, could become the kind of green bond capital, certainly in Europe, if not of the world. Is that now taking a back step because of the more day-to-day crises that regulators are looking at?
I think that's a really big risk. I think you're absolutely right. The UK was a leader, generally speaking, in building an economy to get to net zero. The UK was fantastic in terms of an early move into offshore wind, really is the market leader in terms of offshore wind. We talked earlier about how, from a fiscal and monetary perspective, we need more credibility and more visibility. We need exactly the same on energy policy. You can see the government at the moment thinking about renegotiating contracts for renewable energy. There's no visibility for investors in those markets, and that's going to damage the UK's journey to net zero, which is important for climate, but also really important for economic growth. You know, we've seen what the US has done with the Inflation Reduction Act. We've seen how that's going to set the US on a pathway to lower energy costs and to more competitiveness. And we already see companies actually across our investment universe relocating manufacturing that was going to be in Europe back to the US because it's just a better place to be from a cost perspective.
But Deirdre, how do you explain this so that the government is not focused too much on net zero because they're trying to focus on other things? So there's maybe a reluctance, because we also heard, you know, Jacob Rees-Mogg talking about fracking. So is there a reluctance to embrace what the previous government had done, or is it just that investors are no longer there because they worry about other things?
Investors are absolutely there. Investors are looking for places to put money to work that can be resilient through a recession, and the government needs to understand that.
Okay, Deirdre, thanks so much. Deirdre Koop with our portfolio manager at 91. Now, coming up, German Chancellor Olaf Scholz will reverse a long-held position and support the issuance of joint European Union debt to ease the energy crisis. We'll explain the significance of that move shortly. This is Bloomberg.
In light of elevated global economic and financial uncertainty, moving forward deliberately and in a data-dependent manner will enable us to learn how economic activity, employment, and inflation are adjusting to the cumulative tightening in order to inform our assessment of the path of the policy rate.
The Federal Reserve is committed to returning inflation to its 2% average goal. To do so, I expect we will need to raise rates further and then to hold that stance for a while. Of course, the exact path forward for policy will depend on the evolution of the economy and risks to the outlook.
Well, the federal vice chair, Lael Brainard, and Chicago Fed President Charles Evans on the rate outlook for the central banks. Now, we've been talking a lot about gilts. Of course, this is after what the Bank of England announced for the third time. At the very least, a lot of market participants say the Bank of England may need to persist with the backstop for another 2 weeks. That's according to our Van Ram. He has some great entry points also on the live blog. Remember, it's November 3rd that we have the BOE meeting. How much how big a margin does the Bank of England need to raise by to make sure that the market get the right figure on inflation, the right message on inflation? So we also have some of the undue leverage. So we have a great story looking at some of the things that led us to where we are today on gilt. So you can see that 30-year 4.639. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Germany is open to the joint issuance of European Union debt to cushion the blow of the energy crisis. Chancellor Olaf Scholz signalled that the change in position on the sidelines of a summit in Prague last week, as long as the funds are paid out as loans, not grants. The move follows criticism that Germany's €200 billion energy aid could trigger imbalances in the bloc. Now, the heads of the IMF and World Bank are warning of a rising risk of a global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world's economy will enter recession this year or next.
The risk of recession has gone up. The total amount that would be wiped out by the slowdown of the world economy is going to be between now and 2026, $4 trillion. This is the size of Germany GDP gone.
Now, French drivers face more fuel shortages after unions vowed to continue strikes at the country's biggest refineries. President Emmanuel Macron's government has been urged to mediate after the dispute left almost a third of petrol stations with supply shortfalls. And Japan has reopened its border today to vaccinated travellers from 68 countries, ending almost 3 years of pandemic restrictions. With a weak yen and relatively low inflation, hopes are high high for a rebound in visitor numbers as airlines ramp up international flights. Reports have emerged of Iranian oil workers joining protests which have continued over the death of a 22-year-old woman last month in custody of the so-called morality police. Unverified social media videos show dozens of labourers and ununiformed workers marching. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. I have to say the rising of Iranian women is pretty incredible. Coming up, what will the metaverse truly look and feel like? We discuss all things virtual reality with Herman Narula, Chief Executive of Improbable. This is Bloomberg. Inflation angst fears build over the impact of rising interest rates. Jamie Dimon and Nobel Prize winner Ben Bernanke joined the chorus of caution. The BOE steps out its bond market intervention this morning. Parliament resumes today for the first time since Kwasi Kwarteng's mini-budget wreaked havoc on markets. Plus, Joe Biden pledges more military support for Ukraine as Vladimir Putin threatens more attacks on Ukraine. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So the Dutch finance minister says the European Union must ensure there is effective oversight of government plans to reduce debt. Sigrid Kaag spoke exclusively to Bloomberg's Maria Tadeo.
It is horrific. The indiscriminate shelling of innocent civilians, cities, constitute real violations, tangible violations of international law, humanitarian law. And I've heard the Commission already speak of war crimes. But our heart goes out to the people of Ukraine. And it's also very clear that their will not be broken, nor that of NATO or the European Union. We need to stand firm with Ukraine, particularly and even more so in the face of such cruelty and such war violations.
And when you say we need to stand firm with Ukraine, does it mean sanctions stay put? Maybe they go in crescendo? That support financially will also materialize, not just on weapons, but the cash they say they need?
Well, on all levels, politically, militarily, financially, the humanitarian support, there is one front. It's a European front and, of course, our NATO allies to make sure that the Ukrainian government and the Ukrainian people get what they need in order to withstand these atrocities.
And of course, as we reported today, what they want is air defense systems, and Russia also branded us a terrorist state. But going into the impact that this has to in Europe, because we can feel it pretty much every day in the cost of living, food, crisis, inflation, energy bills. When you look at this blackmail in the hands of Russia, how do you respond to this economically? How can you alleviate some of the pressures if you can?
Well, we do need to alleviate. We do need to also invest, of course, and support our own citizens, particularly because it can't be that the outcome of this war will be that our population is suffering, that they feel there might be a loss of support for this righteous effort to support peace and security and international law standing by the people of Ukraine. So it can't be. So we need to make money available. We need to have the right support packages, as we have been doing, each country in their own way, but often in a coordinated manner, because our own populations also need to be able to get through winter, and the response to blackmail can never be that we give in.
And you mentioned the coordination, and that takes me perfectly to my next question. There has been, over the past week, a lot of debate in Europe about national measures are great, but not everyone has the same fiscal capacity. It's not a secret that Germany created a lot of tension with this 200 billion euro package, and there has been now calls that perhaps this merits new tools or a form of joint response. When you look at it from the Dutch perspective, how do you look at this?
Well, in all fairness, we've also recently announced a very generous additional package in support of households and small to medium-term enterprises. And it's a temporary set of interventions, as is desirable by, for instance, the ECB or the IMF. If you support, if you help, do it tangible, do it targeted, and make it time-bound. But I also acknowledge that, of course, the pockets of every country are different. The fiscal space for every country is different. But many countries have undertaken similar measures, sometimes earlier, and you can't compare them one-on-one. What we've been trying to do as ministers of finance, and of course also in the informal meeting in Prague, the the prime ministers, to see what we can do together, where the means can be found, and how we can take a longer-term view, because this crisis will be with us for quite some time.
And the market, however, they're looking at potentially something that may not be a recovery fund, but may see, joint action or actions backed by the European Union's AAA rating. Is that something that you would contemplate?
Well, from the Netherlands so far, we've said there's a lot of money available in the different funds that we've created for other crises. I mean, and the Recovery Fund, Repower EU is a recent one that also accelerates the energy transition. There are billions and billions of funds available that have yet to be allocated. Let's look at that first, and let's see what our joint course of action will be. And at the same time, we always call for national government action where that's feasible. At the same time, we need to look towards debt sustainability, not just of our own country, but of the Eurozone as a whole.
Let's get straight to your Bloomberg Business Flash now with Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned the UK is pushing ahead with plans to set a cap on the revenues of renewable power producers. Government officials held talks yesterday with energy companies on a mechanism similar to the one proposed in the EU. The move would limit revenues and channels the funds to help struggling consumers. Now, Rivian shares have tumbled after the EV maker said it would recall nearly all the cars it delivered after discovering a minor structural defect. The US company says while the issue was only found in 7 vehicles, it's recalling about 13,000. Rivian only recently overcame production problems and parts shortages. And London's most expensive home is up for sale again. Bloomberg has learned the chairman of embattled Chinese real estate giant Evergrande has put the Knightsbridge mansion back on the market. The 45-bedroom property overlooking Hyde Park was snapped up for £210 million in April 2020. And that's your Bloomberg Business Flash. Francine.
I really dread to think of electricity and gas bills come the winter, but I know I'm not who they're marketing to. Leanne, coming up, Russia's strikes on Ukraine are widely condemned as President Putin threatens to launch more missiles. We have the full story on next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Facebook parent company Meta has made a number of acquisitions to bolster its offering in virtual and augmented reality. The chief executive, Mark Zuckerberg, has said he wanted the company to popularize the metaverse, a more immersive version of the internet. However, my next guest believes that Meta's vision is misleading. In his new book, Virtual Society, there is the book, he argues that Mark Zuckerberg's company will not be the sole owner of the Metaverse. Well, we're delighted to be joined by Herman Narula, chief executive and co-founder of Improbable. Last time we spoke, you were talking about the book, and now it's out, so congratulations on that, Herman. Overall, there was a lot of buzz on the Metaverse. I wonder whether every day we talk about inflation, cost cutting, the cost of living crisis, and whether that's making a lot of the big companies less likely to spend millions, if not billions, in trying to work on the Metaverse.
I think for those working on the Metaverse, yeah. But for those that are actually looking to create content within the world, it's the opposite. If you're a major sports league today, your attendance is going to be down in the context of people not being able to afford tickets or to travel. So the Metaverse offers new opportunities for you to engage your audience at a much more cost-effective basis.
But do you think it will be taken more years because of the cost of living crisis?
I think it's already happening. Outside of Facebook, which gets all the attention, there are so many companies that are already making breakthroughs in everything from the economics of the Metaverse through blockchain and Web3, through technology like ours to handle large scale. So I think it's happening with or without that investment at this stage.
And I know in the book you also argue that, look, the usual definitions of metaverse are, confusing at best, unconvincing at worst. I mean, they are pretty vague. How would you describe the metaverse? And if you're like an advisor to Coca-Cola right now, how do you tell them to get in?
I'd say the metaverse is simply this. It's a network of meaning that connects together different socially constructed realities. So it's really a way for something that happens in the world of sport or fashion to impact the real world or to impact a virtual space. It's a network of interconnected identities, objects, and interactions. So if you're a brand, then the metaverse is the ultimate way for you to engage with your audience because you can create embodied interactions where thousands of people could hang out with you, celebrities, the brand, and even engage in experiences that wouldn't normally be possible. So I would say it's about discovering a new skill, just like the origin of the internet kind of caused these brands to think differently about how they engage with people.
Herman, I guess the only setback is that it could take a lot longer if you don't have someone like Google or Facebook fully behind it because of the infrastructure, right? It's a little bit like EVs. If you don't have the right infrastructure, then you're not going to reach the client as quickly and as most powerful as possible.
I think that's a misconception. Earlier this year, we ran events with thousands of people hanging out in the Metaverse, and it cost us less than $100 an hour to run these events with 15,000 people in them. So it doesn't take VR headsets and extremely expensive infrastructure to build vastly complex worlds. I think Facebook is looking in the wrong place.
But this is what, 0.1% of the population that have so far experienced it, and how long do you think how big do you think it'll become?
Well, the games industry is already more than 3 billion people. Yeah. So if you look at the Metaverse as VR, then yeah, of course it's a niche. Yeah. But if you look at the Metaverse as something you're going to access from your phone, from TV, from every possible device, interacting with these interesting virtual worlds, we already have the infrastructure. We've already got game engines. We've already got the networking technology. So I think it's a matter of time and not that long before we start to see experiences that touch people in their everyday lives.
I know we talked about this last time, first mover advantage. I don't know whether that's changed in terms of winners and losers.
I think that this isn't going to be a market that is won by one centralized company. It's going to be won by a network. And I think that network is going to be rooted in blockchain and Web3 and in the idea of sharing value between businesses. That's a very new concept, and it's not something existing behemoths are well set up to take advantage of. So I don't know that it's going to look like the last disruption in terms of in terms of what guarantees victory.
But do you see, I mean, I mentioned Coca-Cola, I could have mentioned a number of other big players. Do you see their commitment increasing to the metaverse or scaling back?
Oh, absolutely increasing. I mean, it was recently announced that we're going to be profitable for the first time in my history. That's entirely based on companies making investments in building metaverses in virtual worlds with a 2-year, 3-year time horizon. These are brands in fashion, in music, in film. And I see a clear gulf between those that are investing now and are going to have the advantage of having built and calibrated really effective experiences, and those that are going to be latecomers and are going to be left behind.
And you don't think, I mean, again, in our world, we talk about earnings and we talk about the concern that inflation will erode a lot of the margins for a lot of these big companies. You don't think that will have an impact on spending?
Games tend to be recession-proof because they're the cheapest form of entertainment. On a per-hour basis, games give you more activity for less dollars spent. You can do them from home. You can do them from anywhere in the world. You can interact without necessarily needing to travel. So in the last recession, video games actually did reasonably well. Yeah. I personally think virtual experiences, especially if people start working from home as well, are going to become a much, much more effective use of capital. And I think a poor economy will only help it.
Can Europe really rival China in some of the innovation in this space?
Sure. I think, sorry, could you repeat the question there?
So can Europe rival China? We know China is doing quite a lot in this space. They do it cheaper, they have more data access, and can get things quicker.
So as I argue a lot in the book, the value of the metaverse comes from deep, rich social experiences and self-expression. Those are pretty counter to the rules of building content in China. While China has a lot of advantages in terms of its tech companies and its investment, its desire for control over the experiences actually runs counter to building valuable experiences. Also, the content, the brands, the opportunities, the communities that are necessary to flourish, for the metaverse to flourish, I don't see them existing within that system.
All right, Herman, so interesting. Thanks so much. And again, congratulations on the book. Herman Narula, their Chief Executive Officer and co-founder of Improbable, with the book just out. Now, let's also talk about geopolitics and foreign affairs. U.S. President Biden has condemned what he calls the utter brutality of Russian missile strikes across Ukraine, as Vladimir Putin warns of more attacks. Well, several cities, including Kyiv, were hit by a barrage yesterday, killing at least 11 people and wounding over 60. The strikes came after Putin blamed Ukraine for an attack on the bridge linking Crimea to Russia. Let's get straight to Bloomberg's executive editor for international government, Roz Matheson. So, Roz, is this actually a turning point in the war?
Well, if anything, it's just another sign of the darker turn that this conflict is taking, if that's possible, as Russian President Vladimir Putin's troops really struggle on the ground. They're being backed out of parts of eastern Ukraine. They're struggling in southern Ukraine. And you can see that combined with the attack that happened on the weekend on that bridge to Crimea, a real prestige blow to Vladimir Putin and the pressure he's getting from hardliners at home. We can see the chorus growing on that. That suggests suggests that he doesn't have a lot of options, that this is a moment where he's decided to dig in no matter what. He's decided that he's there. He needs to have some kind of outcome from this war that he can say that he gained something from it. And so, if anything, he's digging in. And that's heading us into a very difficult winter, obviously. And this move to target infrastructure by hitting multiple cities yesterday, the message was, we can still hit you no matter where you are. In the far west of Ukraine, in the south of Ukraine, we have weapons and missiles that will find you. We're going to target civilians, we're going to target infrastructure, we're going to make life very difficult for people in Ukraine in the next couple of months.
Thank you so much. Roz Matheson there with the very latest, of course, on what's happening in Ukraine and Russia. She's executive editor for government coverage. Now, coming up, how one city's policy is changing the makeup of its cars. We'll discuss today's big take on London's EV boom. That's coming up next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany is coming around to backing the idea of joint EU debt issuance to help cushion the blow of the energy crisis. This is as long as the money is dispersed as loans, not grants, and that's according to a Bloomberg News scoop. Now, while details have not been ironed out yet, the topic will likely come up in the discussions as EU leaders meet in Brussels next week. Now, for more, we're joined by Maria Tadeo in Brussels. So, Maria, what exactly is being debated? And good morning.
Yeah. Good morning to you too, Francine. And you made out what is a critical difference here. I think you explained it very well. This is about the loans. It's not the grants. So in other words, it's not a rerun of the recovery fund. This won't be a recovery fund 2.0. That was 750 billion euros back in 2020. Remember, the amount was split. Some was grants, the other was loans. The idea here, however, is that you could see European institutions tap markets that is AAA rated and then get the funding and distribute that to member states that are now crystal clear they will need additional help to deal with the winter crisis. The core issue, and this is fundamentally the thinking behind this, is that if you tap the market as EU27, you will get a better funding rate than you would if you're, let's say, a peripheral country going out to the markets by yourself. So that's where the debate is at. But I should note, however, this is something that would have to be presumably agreed by the EU27 unanimously. And it's clear that we're not there yet. We just played an interview with the Dutch finance minister, which she said it very openly. She does not see the need for new tools to deal with this crisis.
So, Maria, a change of course of heart in Germany is very important, but not definitive. So will there be enough consensus?
Yeah, and it's not definitive. And again, I should also note that the German government has not made this position official. This is a story that broke yesterday on the Bloomberg, citing a number of sources. But officially, Olaf Scholz has not said this on the record. But the choreography now, Francine, from now until next week will be that today energy ministers will meet. At one point, the Commission will come up with a plan of action that may or may not include this. That will be a key point. And then it's up to European leaders next week on October 20th and 21st to really figure out what type of response they're going to put up with this energy crisis and what type of consensus they can build around some of the measures that are being floated pretty much every day, I should say, in Brussels. This is a very active debate here.
Yeah, certainly is. And of course, a lot of traders were, forwarding that Bloomberg scoop yesterday because it's definitely a game changer potentially. European correspondent Maria Tadeo in Brussels for us. Now, London's polluted air turned the city into an electric vehicle pioneer. Today's Big Take explains that in a bid to tackle the capital's traffic congestion, the city introduced some of the toughest restrictions on heavily polluting cars. Now, the policies almost flipped a switch on the adoption of electric vehicles. Now, let's bring in Bloomberg's Craig Trudell for more on the story. Craig, I'm really happy to speak to you about this because over the last 3 weeks, there's such bad news coming out of the UK. If I'm 100% honest, this is actually a feel-good news. So what are some of the conversations that you've been having about the impact it's had for EV?
Yeah, for me, this really started a few months ago when Uber was eager to talk about why they were having such great progress in the fleet in the city of London turning over. And it was a lot of companies want to tell a feel-good story about how things are improving within their operations. But this one really stuck out to me because of the sort of long and tumultuous history of Uber in London. There's been a lot of tension between the mayor's office and this company. but the company really spoke effusively about this idea that road pricing policies was a huge distinguishing factor and sort of a driving force in why electric vehicles were having so much more success on the platform. You don't necessarily have, a big difference in terms of incentives. The charging infrastructure is coming along, but it isn't necessarily way ahead of other places. The reason why London has had such success in drivers going out and getting electric vehicles is it really costs a lot to drive in the city every day unless you're driving an EV now.
Yeah. So is it a prescription that other parts of the world and other metropolises can emulate?
Yeah, there's absolutely going to be an effort to replicate this elsewhere. Even in New York City, there's been a lot of talk about that and not necessarily a lot of follow through, but we've been sort of assured that this is going to be tried again in New York City. The idea that a company like Uber, where you wouldn't necessarily think that this policy would be in their business interests, the idea that they've come forward and talk about, the fact that this has been, such a big driving force and them being able to achieve their sustainability goals does give you some hope that maybe some other cities will try this out because they're getting they're seeing the results from the City of London and also perhaps getting some pressure from, the private sector and companies like Uber.
I was in Amsterdam yesterday and actually was in a Tesla. It was a taxi. It's always a bit fiddly because you don't know how to open the door.
Yes.
You always feel a bit dumb, but then you feel like you're doing something for the environment.
Yeah, you're actually, we're hearing about that now that there's a big push with Uber actually in the U.S. with more Hertz cars that are Teslas. A lot of people, walking up to their Uber and having trouble getting into the door. It's interesting.
It's a real thing. There you go.
Yes.
It's not just blonde Francine. Craig, thank you so much.
Thanks.
Craig Trudell there, of course, our European car czar. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, or Anna Edwards is here in London. I know they'll spend a lot of time talking about the markets. They'll also spend a lot of time looking and hearing about this BOE intervention. We just heard from Neil Wilson, for example, great analysis on what it means for the Bank of England today, widening its gilts market intervention to counter what it says is a material risk to the UK financial stability. So the BOE now including index-linked gilts in the basket of assets it purchased as part of the intervention in the wake of the Chancellor's mini-budget. But will they have to go a step further? That's really a critical question for today. This is Bloomberg.
Powell has now endorsed the notion that there is going to be some pain involved.
This is an environment where the bond market vigilantes are back.
You probably don't want to be the one, validating market expectations of a recession. You probably don't want to add to the general bleakness in the system.
I think there's worse to come for the market, unfortunately.
The biggest concern with the dollar is what it's requiring other central banks to do in terms of tightening when their own economies are looking to head into potentially severe recessions. And then a financial accident.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. More intervention. The Bank of England adds inflation-linked bonds to its purchases to stabilise the market and avoid what it calls fire sale dynamics. Broader gilt yields have been dropping after yesterday's climb. A $240 billion wipeout. Chipmaker stocks slumped in Asia, hurt by continued fallout from the fresh US curbs on China's access to technology. And a Bloomberg scoop, Germany's Chancellor Olaf Scholz makes a shift. He's now supporting joint EU debt issuance with conditions to cushion the blow of the energy crisis. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, another day, another intervention from the Bank of England and risk aversion to the fore, it seems, here in Europe.
Yeah, and that was definitely the case in Asia overnight, and a lot of it driven from that semiconductor story you were just mentioning, Anna. A lot of pain for the chip stocks out there. And as you had markets like Taiwan, South Korea, and Japan opening up after holidays on Monday, they were catching up to some of those real losses we have seen over the last day or so. So Taiwan's benchmark stock index down about 4.4%, the worst day since March of 2020, now at its lowest level since November of that year. And of course, a lot of that had to do with Taiwan Semiconductor, down a record 8.3% overnight. Really speaks to the chip pain that is out there. And that is filtering through to foreign exchange as well. Both the Taiwanese dollar in Asia as well as the South Korean won, as you had the likes of Samsung lagging on the day too, are under pressure. The South Korean won actually won at 14.35 to the dollar. That is relatively weak, not quite at the weakest levels we have seen so far this year, but still we're getting close back up to that point. And of course, in the bond market, we have seen a lot of selling pressure in global bonds around the world, and that definitely was true in the Asia Pacific region, including in Australia, where that 10-year yield rose 17 basis points to 4.03%. Matt.
All right, well, we're seeing big yields here as well in the U.S. First off, futures are down another 0.8%. So it looks like we could come back under 3,600 this morning. And then we're seeing the 10-year yield up at almost 4%. It's at 394.09 right now, but pushing up against that level. The 2-year yield at its highest level since 2007 at more than 431 right now. NYMEX crude trading TI at 88.74 a barrel. So it's come off a little bit on concerns that demand will drop in a recession, and Bitcoin is down 0.7%, but still hanging around the same trading band where we've seen it, 19,108. Can anything knock Bitcoin off of this, out of this range? It doesn't seem like anything has over the last few weeks, at least. Anna, what do you see in Europe?
Yeah, we'll get to another Bitcoin conversation, another wider crypto conversation later in the program, won't we, Matt? In Europe, I see red, plenty of red, negativity across European equity markets. The London market weighed down by its emphasis on energy stocks and basic resources. And with that in mind, I'll show you what I've picked out to talk about here on the European space right now. There is a concern around growth today, and as a result, basic resource stocks down by 2.5%. It's the same concern around growth weighing on Brent crude, 93.83, despite the fact we saw OPEC, of course, deciding to cut back on production. That was last week's story. Today, the growth concerns seem to be dominating, at least today. Now, here is where a lot of the interest is, a lot of the action is, and I mean broadly in the UK gilt market. What we have seen today is the Bank of England widening what it's going to do this week in terms of buying up gilt assets, adding inflation-linked gilts. We'll get more detail on this from Danny Berger in just a moment. But I just wanted to flag what's going on with the crucial 30-year gilt yield, because we talked about this yesterday being just above 4.5. We then saw all across the UK curve, we saw those gilt yields rise yesterday. Today, the action from the Bank of England did seem to be enough to bring the gilt yields down in the very short term, but not now at the 30-year. That's where we're seeing the 30-year behave a little bit differently and just trying to move in the other direction. Now, Credit Suisse also in focus today, up by 1.7%. Goldman Sachs analyst then, Matt, trying to put a figure, a number on the amount of capital that this business needs to raise. We'll wait to October 27th to get the full restructuring and reorganization of the business. But in the meantime, Goldman Sachs saying they need 8 billion Swiss francs. That's around $8 billion US dollars.
Yeah, and we're hearing other analysts as well say they need that much or even more, right? 9 billion has been called at another shop. So watch closely Credit Suisse shares today. Let's get more, though, on the BOE as it expanded its emergency measures to tackle chaos in the bond market, broadened out the scope with linkers now added. Alan Higgins, CIO at Coutts, spoke earlier on Bloomberg.
I worry they haven't done enough. Quite frankly, I mean, what we saw yesterday was an extraordinary move in gilts and ridiculous move in index-linked gilts. Yeah, you've got a real spiral here. I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
Bloomberg's Danny Berger joins us now for more. So make or break for the Bank of England, says Alan Higgins.
Yeah, I mean, it's just a Bank of England here whose sole purpose at this moment, at least, is making sure this is not a dysfunctional market. It is monetary policy for the sake of stability. And here's the ridiculous move, as Alan Higgins put it for our radio listening audience. It's the daily move in those linkers, those 10-year UK inflation-linked bonds, moving 64 basis points yesterday, a record move. That is not something that can be explained by fundamentals. This is a market that is extremely tense, considering the Bank of England didn't have linkers in its purchase program previously. So the market is testing it. And, of course, those now infamous LDIs, they hold a lot of these linkers. So the deleveraging continues. And throughout the Bank of England statement and the notes attached to this statement, it keeps saying stability over and over again. They wrote dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to UK financial stability. But this brings it back around to Alan Higgins' point. Is it enough? Look, the bond market is calm today in the UK, but it is noteworthy that we are seeing the long end of the curve. Some of those gains are starting to peter out. We're not even down 1 basis point. Yes, belly of the curve is seeing some bids. So the fundamental problem remains, Kailey. It is a market concerns whether these pensions have deleveraged enough, considering they didn't take the BOE up on many of their purchases, and a market that is testing the central bank, considering these moves are really against what their aim is to bring inflation down.
Dare we say vigilantes. Bloomberg's Danny Berger, thank you so much. Now let's turn to the chip space. A whopping $240 billion has been wiped off the market value of the global semiconductor sector. Chip-related stocks in Asia have plunged after the Biden administration imposed curbs on China's access to semiconductor technology. Bloomberg's Tom McKenzie is joining us now with more. Tom, this is absolutely brutal. And of course, it's not just a matter of the Biden administration's moves. The earnings picture and demand picture for these companies is also not looking good.
It's looking bleak, isn't it, Kailey? Look, you touched on some of the key points at the top of the show. Of course, some of these markets, as you say, waking up after national holidays. And so you see that route as they digest the news from the US. Of course, there's more than 100-page document that came out of Washington on Friday. So you saw that impact on the likes of TSMC over in Taiwan. You saw that impact on Samsung. TSMC ending the session down by more than 8%. And across the industry, $240 billion. And then you mentioned this as well, the ripple across to the currencies, because the importance of the chip-making industry and that sector to the economies of Taiwan and Korea in particular. There was a read across also to the chip makers and the producers of some of these ultraviolet lithography machines, particularly ASML here in Europe. That is lower the last time I checked. ST Micro over in France and Infineon Germany also taking a hit. Morningstar, the analysts there saying, look, there are going to be more uncertainties for this sector. To your point, it's not just the restrictions put in place by the Biden administrations. It's also the fact that there is now very weak demand for consumer electronics. So that's a further drag. China's response is also something we're watching for.
All right, Tom, thanks very much for that. Bloomberg's Tom McKenzie there talking to us about what's going on in China with chip stocks. Really, it's a global issue. President Biden, on another issue, has condemned what he calls the utter brutality of Russian missile strikes across Ukraine, as Vladimir Putin warns of more attacks. In a call with Ukrainian President Volodymyr Zelensky, Biden says the U.S. would continue providing Ukraine the support it needs, including advanced air defense systems. Meanwhile, on the energy front, Germany is coming back around to the idea of backing joint EU debt issuance to help cushion the blow of the energy crisis. This is as long as the money is dispersed to other countries as loans, not as grants or giveaways, according to a Bloomberg News scoop. While details have not been ironed out just yet, the topic will likely come up at the discussions as EU leaders meet in Brussels next week. Let's get to our European correspondent, Maria Tadeo, in Brussels for more. So, Maria, what are we talking about here? More EU shared debt.
Yeah, but Matt, this is critical to get the nuance here. And in fact, it has been in the public debate now for a week. Last week on the Monday, Tuesday, when the Eurogroup was meeting in Luxembourg and I covered that meeting, to me, it became obvious that something behind the scenes was cooking. And what you have here is potentially now an opening that would see joint debt, but this is not a replay of the Recovery Fund 2.0. This is not going to be the same thing. Remember, at the time, this was the pandemic and this was a huge mega fund that was funded by the EU. It had grants and loans. The idea here is that facing this energy crisis, it has become obvious that member states of the EU will need additional funding and additional resources. And the key is at what rate. Now, some countries are suggesting it's better to do it as EU 27. You will get a better rate in the market, especially if you compare it to peripheral countries that may find it difficult to do that by themselves. Now, what the Germans are suggesting is that this is something they could explore. But I would note also one thing. If Germany opens up, you get political momentum going into this. But you also need to factor this is a decision that will have to be agreed unanimously by the EU 27, as it always gets done. And yesterday, when I spoke to the Dutch finance minister, she frankly wasn't so keen. So this is still a story that is to be played.
Okay, so different to the fund that we saw put in place during COVID, a bit more similar to the Shore program that predated it then,
Yes.
Maria. So a change of heart, some evidence of a change of heart in Germany. That does seem important, but is there enough consensus around that?
Yes, Anna, it's not the recovery fund, it's the Shore. I was trying to avoid the technicalities, but you beat it to me, and yes, that's exactly what it is. This was a program that preceded the recovery fund, which was in many ways eclipsed by the magnitude of this fund. But, you know, in terms of the choreography going forward, to answer your question, I think things will have to move in the next 2 weeks. The Commission has been given a deadline to come up with a plan to deal with the escalating cost of the energy crisis. Energy ministers are meeting today. At one point, this plan will have to be presented to the different nations of the EU. And then we're expecting, remember, this is what we heard from the French president last week, come October 20th and 21st, this is decision time. There has got to be something on the table that they're able to make a joint decision. So really, this is 2 weeks where I predict there's going to be a lot of back and forth between Brussels, Paris, Berlin, and the different capitals.
All right, the clock is ticking, and we trust that you'll be there for us reporting on every single move. Bloomberg's Maria Tadeo in Brussels. Thank you so much. Now let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with Las Vegas Sands, which saw a pretty sizable down day yesterday, down about 7.5% after data showed that Golden Week in China in terms of tourism was pretty disappointing. And that doesn't have great implications for the gambling enclave Macau, where Las Vegas Sands gets more than 60% of its revenue. So after the big declines of yesterday, we are seeing those losses continuing this morning, down about 3.4% before the bell. Now, we also are seeing a lot of commodities moving south too, including oil, and that is weighing on energy names in early hours, the likes of ExxonMobil down about 1.8%. And then finally, to bring it back to the semiconductor story we were just discussing with Tom McKenzie, of course, the pain not limited to Asia. It was felt here in the U.S. over the last several days. NVIDIA, the big large cap U.S. chipmaker, down 11% in the last 2 sessions, and those losses continuing this morning, down about 1.5% before the bell, Anna.
Kailey, we will get back to the conversation around bond markets shortly. We'll talk to Nicola Mai, PIMCO portfolio manager and sovereign credit analyst, a great guest to talk to. A day after we saw the biggest ever surge higher in inflation-linked gilt yield, the Bank of England stepping into the market today. Across the regular gilt curve, we see a bit of calm, but maybe not quite at the long end. We'll get the views of Nicola Mai shortly. Antoni Trenchev also joins us, Nexo co-founder. We'll talk about the state of crypto as we head deeper into a winter, perhaps. Plus, how London's polluted air turned the city into an electric vehicle pioneer. Read more in today's Big Take story on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York, Anna Edwards with us out of London. We are seeing liquidity worsen pretty much everywhere, but it's very bad in the UK, which those of you watching on TV can see here in blue, and in Italy, which you can see in yellow. Those of you listening on radio, just take my word for it. Or when you get to your Bloomberg terminal, type G #BTV 4289 to see this chart. Now, Ksenia Galuchko joins us right now, Bloomberg Equities editor, to talk about what this lack of bond market liquidity is going to mean for the equity market. So far, it's not been good news, Ksenia.
That's right. It's been another dramatic day in UK markets, with the Bank of England coming out with another support measure and being willing to buy up those inflation-linked gilts. Again, right now they've managed to stabilize the market after this major sell-off on Monday. But again, the deadline for the expiration of their bond buying program is this Friday, so we might see more volatility around that. And although I'm focusing on the bond market right now, of course there's repercussions for the broader financial markets in the UK and equities also. Of course, the FTSE 100 does benefit from the weaker pound, but the FTSE 250, the mid-cap, the more domestically focused index, remains under pressure.
Okay, and Ksenia, good morning. So that's the bond markets, the read across into equities. I'm looking at a headline here that says earnings are looking bad, but what's coming could be even worse. Sounds gloomy. Explain.
Oh my God, yes. So strategists are quite spooked about the upcoming earnings season. They say that the third quarter earnings no longer matter because it's all about the guidance for the companies. So they're going to be looking out for those warnings. We've got many problems in place. We've got surging inflation, labor costs, supply constraints, margin pressures. All of these things are going to come in play, and the earnings season kicks off this Friday with JP Morgan, Citibank, and we will see how things go. This could put more pressure on the equity market, which is already struggling quite a bit, with the S&P 500 poised to hit possibly another November 2020 low this week.
Well, before we can get to JP Morgan on Friday, though, Ksenia, we have to get through inflation data on Thursday, which is going to be crucial in terms of how this market is thinking about Federal Reserve policy. What could it mean for the policy pivot narrative that Goldman Sachs says it's too early for?
Absolutely, yes. And Goldman and other strategists are warning that this whole pivot narrative that did drive a recovery in the summer and also in the early days of October is going to be flawed. And inflation is likely to come in high again, possibly higher than expectations even, because we have seen oil prices come up recently because of the OPEC deal that did drive up the oil prices. So inflation is going to stay sticky for now. And in general, with the labor market remaining very robust, as we saw from data on Friday, the Fed is unlikely to pivot. And I think Powell has been very clear in his message that they're going to stay on their hawkish path.
Okay, Ksenia, thank you very much. Bloomberg's Ksenia Galuchko with the latest on markets. And for more market analysis, check out MLIV Go, the function to use on your Bloomberg terminal to find the markets live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. More allegations in the Elon Musk Twitter battle. Bloomberg has learned that just before the billionaire revived his proposal to buy the social media company, he accused Twitter of ordering a whistleblower to destroy evidence. According to court filings, Piotr Zatko said he burned 10 handwritten notebooks and deleted 100 computer files at the request of managers as part of a $7.8 million severance package. Japan has reopened its border today to vaccinated travelers from 68 countries, ending almost 3 years of pandemic restrictions. With a weak yen and relatively low inflation, hopes are high for a rebound in visitor numbers as airlines ramp up international flights. Meanwhile, the Chinese Communist Party's flagship newspaper endorsed the country's COVID-0 policy for a second day in a row, dousing hopes that President Xi Jinping will relax controls soon after a key political meeting later this week. The report calls the policy, quote, sustainable, and says the country must stick to the strategy because it's key to stabilizing the economy and protecting lives. And the heads of the IMF and World Bank are warning of rising risk of a global recession. IMF Managing Director Kristalina Georgieva says higher interest rates are adding to debt pressures on developing nations. She says about a third of the world economy will enter recession this year or next. And it speaks to the policy dilemma for both monetary and fiscal policymakers, Matt, in that inflation is the problem everyone was first focused on. The policies you use to fight inflation are going to mean a hit to growth.
Yeah, absolutely. And I mean, the idea is they should have been using these policies earlier, then they wouldn't have had to use such heavy, blunt tools to fight inflation. But now it's too late, and the only thing they can do is cause a recession in order to end inflation.
Yes, and we heard Jamie Dimon adding his voice to those gloomy calls, and Ben Bernanke, both voices cautioning about what we need to watch out for as the global economy slows down. I spoke to Alan Higgins. We heard a little bit from him earlier on in the programme. I spoke to him in earlier programming here in Europe from Coutts & Co, and he was saying, yes, he's concerned about these global forecasts of doom, but also that markets have been well aware of this for some time and that perhaps the market narrative is a little bit ahead of that, and we're still looking for that pivot. Say it quietly. I know we're not supposed to say that word too loud these days. Right, Nicola Mai joins us shortly. PIMCO portfolio manager and sovereign credit analyst. Great voice to have on the program today as we look at what's been happening with gilt yields really rising yesterday, coming down a little today. The Bank of England expanding its bond buying program. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. More intervention. The BOE adds inflation-linked bonds to its purchases to stabilise the market and avoid what it calls fire sale dynamics. Broader gilt yields drop after yesterday's climb. A $240 billion wipeout. Chip makers' stocks slumped in Asia, hurt by continued fallout from the fresh US curbs on China's access to technology. And a Bloomberg scoop. Germany's Chancellor Olaf Scholz makes a shift. He's now supporting joint EU debt issuance with conditions to cushion the blow of the energy crisis. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. We continue to try to find solutions to the European energy crisis there, Matt. But here and now in the markets, a lot of risk aversion, gloom and doom being talked about quite a lot.
Yeah, absolutely. I mean, we see continued drops even after the fall in the cash trade yesterday. The continued drop in the cash trade yesterday, and now futures are off 0.8% this morning. So down below 3,600, and we came down pretty close to that in the cash trade yesterday. The 10-year yield rises right now at 394.49. I believe it's gone all the way to 399.
Yep.
Yes, thank you,
Touched
Kailey.
about 4%.
Touching the 4% level, but we haven't really gone through that. So we're on 4% watch, I guess. The 2-year yield is the highest since 2007, up to 431, and the 3-year at 435 right now. NYMEX crude coming down on those recession concerns. Jamie Dimon said yesterday on CNBC, expect a recession in 6 to 9 months. Of course, a lot of people think we already had a recession, depending on how you define it. Nonetheless, 88.71 is the level there. The China concerns have to play into this as well. Because of the restrictions Biden put on their technology sector, they said that their recovery will be slowed. And then Bitcoin, you know, it hasn't moved out of this 20,000 range, 19,081. For a while, I didn't want to put it in here anymore because it wasn't changing. Now I think it's interesting that it isn't. I mean, we just don't see Bitcoin breaking out of this trading range, Kailey.
Yeah, it's interesting, and we've heard from a couple of voices that may be due to the fact that you are seeing more institutions in the space rather than just retail investors, and those institutional investors may act as somewhat of a stabilizing force. That is a conversation we will continue in just a moment here on Early Edition, and then, of course, you and I will have more on that on Bloomberg Crypto later today. As for what is happening right now in pre-market trading this morning, you're seeing energy under pressure with oil prices down, as Matt was talking about. The likes of Marathon Oil, Occidental Petroleum, each down in the ballpark of about 2.5%. But of course, the sector that we all really have been focused on in the last several days is the semiconductors. A number of factors here, one being the Biden administration curbs on U.S. technology to Chinese chip makers. So that could rattle supply chains and potentially damage the revenue operations of U.S. chip makers who do business in China. But then also you have to consider the earnings picture with a lot of warnings out of these companies about slowing demand. So that is putting continued pressure on the space. NVIDIA down 11% in the last 2 days already, down another 1.5% this morning. And Advanced Micro Devices also down by about 1.3% before the bell, Anna.
Kailey, here in Europe, we see continued pressure on European stocks broadly. Many sectors in negative territory today, down by 1.1%. Basic resource stocks, energy stocks, all of those feeling the pressure as we see weaker commodity prices. Growth concerns very much to the fore here in Europe today. This is what's going on with the yields on the 30-year gilt here in the UK. And actually, this stands in contrast to what we're seeing at other tenors of the curve here in the UK. So we heard yesterday from the Bank of England they were confirming they're ending their bond buying programme at the middle of this month, but then they added another program that will run till early November. Today that didn't soothe the markets quite enough. We saw gilt yields moving higher yesterday. Today they came forward with another program. We heard about this from Danny Berger a little bit earlier on. This is inflation-linked gilts added into their existing programs, so they're now buying those as well, trying to stabilise those, stopping the surge higher in yields we're seeing there. And so what that did is it did actually soothe the markets a little bit, and we've seen that the yields have been coming down across much of the UK curve, but not at the 30-year, where we are seeing some selling of 30-year gilts and the yield going up, as you can see. Credit Suisse up by 1.2%. And this is, of course, in the run-up to the 27th of October when we get the full restructuring announcement from Credit Suisse. Goldman Sachs, though, trying to put a number on the amount of capital this business needs to raise. They say 8 billion Swiss francs, US dollars, almost the same. And so they're putting on a number on it, but maybe some people had a bigger number in mind. The stock is higher.
All right, we'll continue to watch that story for sure, among the most read on the Bloomberg terminal. I want to go though, back to the bond market right now. Let's talk to Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. And those sovereign credits are getting more and more expensive, or I guess yielding more, depending on your view. Nicola, how do you see the rising yield environment?
Yeah, I mean, I think the rising yields, first of all, is a very good opportunity for bond investors that haven't seen these levels of yields in 15, 20 years. I mean, after minimum record lows for bond yields, we now have bonds that actually are interesting. In terms of what's priced in the market, I think the higher yields reflect the central bank credibility and their commitment to fighting inflation. And I think the kind of yields we're seeing now, like maybe 4.5% peak rate for the Fed, 5.75 for the Bank of England, 3% for the ECB, tend to be close to what we think are enough to actually bring inflation back down to target.
Nicola, can I home in on the UK with you here? We're just getting some interesting news lines coming through, which I'll add into the conversation. The Pensions and Lifetime Savings Association in the UK, and we know that a lot of what the Bank of England is doing is focused around the pension industry. That particular organisation is saying that some pension funds want the Bank of England to extend its bond buying. We know that the initial programme is due to come to an end on Friday, on the 14th of October. Just as we see those comments come through from the PLSA, I note that gilt yields have suddenly turned and are now on the rise everywhere across the curve, apart from the 3-year. What are you expecting to see then from the Bank of England?
So I guess the Bank of England, with its gilt purchase program, which started on the 28th of September and was actually expanded today to include linkers, it shows the central bank commitment, as you say, to stabilize the pension fund sector and LDI investors specifically. Now, it's very possible that the program, which, as you say, is due to end on Friday, will be extended, and I think that the Bank of England will be ready to do that. I think it's important to remember this is a financial stability operation. It's really a liquidity operation, which is independent of its monetary policy. So I think while continuing to provide liquidity, it will be important for the central bank to reassert its commitment to bringing inflation back to target. And that is with its policy rate adjustments, not with these measures, obviously.
OK, so you say this is financial stability, a liquidity operation. It's not monetary policy, but monetary policy is looking like it needs to keep moving in the opposite direction. We got UK unemployment data today that showed the lowest level of unemployment in this country since 1974, and that was a lower level of unemployment than had been expected, a tighter labour market than had been expected. Nicola, is there a worry for you about what the Bank of England is doing in this part of the market versus the tightening course it needs to be on elsewhere?
Not necessarily. I think that if they help with liquidity in the long end of the curve, that's fine and needed in a way, as long as you say, as long as they actually show commitment to bringing inflation down. I mean, you're right that the labor market report showed a very tight labor market. Now vacancies are coming down and employment looks to be slowing, but at the same time, labor force participation remains very low. Which means that there has been a destruction of labor supply, which means that there's too much heat in the labor market. So I think as long as the Bank of England continues to raise the policy rate, as we expect they will do, these liquidity operations can come alongside it.
Nicola, to widen the lens back out, you mentioned the opportunity you now see in the bond market, that the case is getting stronger for investing in bonds. Could you get more specific as to where and where you might still be avoiding?
Yeah, so generally speaking, I would say that, I mean, right now we're not taking super strong positions on duration, meaning on interest rate risk, because there's still some uncertainty as to when and where inflation will peak. But generally speaking, we are thinking that the levels we're seeing, and I'm talking about treasury yields as well as gilt yields as well as bond yields, the levels we're seeing are getting more and more interesting. And as we get more and more evidence that inflation is brought under control, I think there's going to be very good opportunities for investors. I also think there are opportunities in the spreads, in the corporate spread space, in the credit space. Let's put it that way. We would really focus on high quality right now because we are expecting a recession. In Europe, it's almost guaranteed. It's very, very likely, but it's also more likely than not in the US. So we would tend to favor high quality credits over lower quality credits. We like structured products, which tend to have protection and decent yields. We also tend to like high quality financials where we see good opportunities. We also like some names in the emerging market space, but you want to be very selective there while the Fed is still hiking interest rates.
Okay, Nicola, thanks so much. Thanks for joining us. Nicola Mai of PIMCO talking to us about gilt markets, treasuries and beyond. When we come back, we'll get back to the crypto conversation. Antoni Trenchev joins us, Nexo's co-founder. What have the stresses and strains in the crypto space of late done to his business? How is his business right now? We'll talk about that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Jim Zelter, Apollo Global co-president. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
The macro backdrop is really affecting us just as it's affecting every other asset class, just as we've seen in your graph there. What does that look like going forward? How cold does this winter get? Well, I think it's highly dependent on the macro situation, the Fed, policymakers in Europe, policymakers in the UK. Now, idiosyncratic crypto elements, we've seen plenty, you've reported on plenty over the last few months. We think the leverage is out of this system now, for the most part. We don't see any massive shoes to drop.
Tim Grant there, head of EMEA at Galaxy Digital, speaking with us yesterday. Joining us now for more on the crypto space, Antoni Trenchev, co-founder of crypto lender Nexo. Very nice to speak to you, Antoni. And we want to get into a conversation about your business specifically, about regulatory thoughts. But I want to ask you first about what Tim was just talking about there, about what's driving the crypto prices at the moment. He was saying he was facing up to the winter and saying it's been a tough macro backdrop, but he thinks that a lot of the leverage is out of the system and he doesn't see another shoe to drop. We've seen quite stable Bitcoin prices recently. What's your view?
Yeah, no, I completely concur with that view. The macro backdrop is what ultimately drives the market right now. Unfortunately, there has been some correlation direct between overall equities and crypto. Leverage is definitely out of the system. That's why we haven't seen any sort of drop below the lower range of around $19,000, $17,000, and we need some new impulses to get us through the higher barrier of around 25, which is the higher bound range.
Okay, Antoni, let me ask you about some of the things that have been going on from a regulatory perspective. Several states alleging last month that Nexo offered its interest-bearing crypto products to customers without first registering them as securities. Also suggesting there was misrepresentation as a licensed and regulated company. I mean, how are you responding to those kind of criticisms?
We pride ourselves in our transparency, and this is the approach we have always had with regulators. We are cooperating, providing the necessary and requested data in a timely manner. I was quite surprised that they decided to go public about something that has been ongoing for over a year now. We have been talking to federal and state regulators, figuring out what, if anything, we have done wrong in the past, but more importantly, how the path forward looks like. And that is what's got me terribly excited, because one thing is clear, it is that they want the earned interest product in the US in compliance with the regulatory framework, which is now shaping up nicely and clearly. And this is the good news, is crypto and the earned interest product in the United States is here to stay and will be, brought into its 2.0 version.
How long do you think this fight with regulators, though, is going to be drawn out, Antoni, both here in the U.S. and do you expect other regulators, other jurisdictions to have the same issues?
Matt, I would love to talk about that, but you also know that I cannot talk about that. And as soon as I can, I will be on the first flight to New York to have a sit down with you and discuss it in person.
Yeah, the invitation is always there. It's a standing invitation, Antoni. Let me ask about the yield then. When I first talked to you, now I don't know how many years ago, I was astounded by the yields that you were offering, and it's been a huge draw for your products. Those yields are now a lot lower, and we see a lot of other, plain vanilla yielding instruments much higher. The 10-year, as Kailey was saying earlier, went over 4%. What are you seeing in terms of the relationship or the demand that investors have for your products now as, plain vanilla bonds yield so much more?
Yeah, well, we have to consider that these yields are on fiat currencies only. So our offering for interest on digital assets remains very attractive, and we are one of the very few players that provide it. So no change on that. If anything, new players are coming in.
What are the levels you're offering right now, Antoni? Can you quote some?
We are offering up to 12%, depending on the structure of your portfolio and your loyalty tiers. But 12% is something you can get on fiat currencies, up to 8% on Bitcoin and Ethereum. So still higher than what most banks would have, even with the push of the Federal Reserve and the central banks. And institutions are coming in. Right now, it is not a retail-driven market. It's more an institutional-driven market, and they play it smart. That's why you don't see the slump below 19,000, 17,000, because all the institutions coming in to buy it up.
All right, so maybe blame the institutions for making the space a little more boring, or maybe that makes it more interesting. Antoni, Anna began the conversation talking about the difficulties many crypto companies have faced. A lot of leverage has gotten washed out. We've seen a lot of projects just collapsing entirely. You have pushed back on speculation about any kind of difficulty financially that Nexo is having. Can you give us more insight into your runway, and if regulatory issues here in the U.S. inhibit your ability to offer some products here, what would that mean?
Sure, we are in great shape, and this means that we have a very strong balance sheet. This means that we are the only crypto lender to have a real-time audit on our reserves to show that our assets exceed liabilities at all times. And what we talked about earlier, everybody that was going to go bust has gone bust, and we came out of this unscathed. Not only that, but we are in a position to help consolidate the space. You know, we are working, still committed to making it work with Volt, which was one of the lenders that got into trouble. We're doing, hopefully completing soon, the due diligence and finding a solution. And so we are in a position to help consolidate the space. I think that speaks volumes in and on itself about how the business was developed, managed to this day. And this is the ultimate test, the reality of running a business real time.
Well, and just on the subject of deals you are doing, Nexo bought a minority stake in the U.S. federal bank Summit National Bank last month. Why do that deal?
Yeah.
What does that do for Nexo?
Well, we are future-proofing Nexo. This means that right now there is a bit of a turf war between regulators. Is this going to be under the SEC? Is it the CFTC? Where does the OCC fit into that? So it is a little bit messy. It's getting clearer, but you know, there have been some conversations about what goes where. So this is Nexo's approach. We work on several different fronts. So regardless of the outcome, we can bring our products and services to the U.S. client in a compliant manner. So, you know, having a stake in a federally chartered U.S. bank helps a long way, and we can use some of their licensure infrastructure to provide our services.
Antoni, thanks so much for joining us. We appreciate you stopping by the studio in London. You are welcome in New York City anytime. Antoni Trenchev there, the co-founder of the crypto business Nexo. Tune in, by the way, to Bloomberg Crypto. That's today and every Tuesday at 1 p.m. New York time, 6 p.m. London time. Kailey and I are going to speak with Sheila Warren, the CEO of the Crypto Council for Innovation. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up for the rest of the day. Ukraine will halt exports of electricity from today after Russian strikes hit power facilities. Facebook parent Meta also will be holding a conference on augmented and virtual reality. We'll have an interview here on Bloomberg Television with Cleveland Fed President Loretta Mester at 6:30 p.m. New York time. And the IMF releases its latest World Economic Outlook as the lender and the World Bank hold annual meetings in Washington. And Anna, we know they have much to discuss.
Yeah, absolutely. Much to discuss. As central bankers congregate at the IMF conference this week, we hear increasing calls for coordinated intervention to weaken the US dollar. Those calls, of course, from outside the United States in the main. Now, Bloomberg's Valerie Teitel is here to take us through why, in her view, blaming the dollar for its strength and blaming it on the Fed maybe misses the point. Valerie.
Thanks, Anna. Now, I want to draw attention to some very large structural shifts that are happening in a few of the world's massive economies. I've got the terms of trade here for the UK, Japan, and the Eurozone. Now, as the energy crisis has escalated, the terms of trade has deteriorated for these economies. That's mostly because they're importing prohibitively expensive energy. Now, you cannot deny that running these deficits, having this deterioration in the terms of trade, inherently weakens your currency. And in effect, by running these deficits to bring the capital back into a country, you need higher yields. So you need to entice these people to, or entice investors to fund your deficits via a weaker currency and higher yields. Now the UK and the Eurozone specifically are attacking the energy crisis via huge fiscal spending. What does that do? That keeps internal demand really high. That keeps your demand for this expensive energy really high. And it will exacerbate these deficits. Now you can't just put the dollar strength all on the U.S. because you have to realize that the actions by the UK, the actions by the Eurozone, especially Germany with their big fiscal spending packages, are pushing this narrative and pushing their currencies weaker.
Yeah.
Yep.
Okay, and so that's a sort of fundamental reason as to why we see weakness in other currencies, as well as the sort of the move into the safe haven of the dollar, Matt, which is something we've seen as a very regular phenomenon during times of stress.
Yeah, exactly. I think Valerie made some really good points, and especially the German fiscal spending package has caused concern across Europe, right? They're spending 200 billion euros. Other countries either can't come up with that or can't borrow it as cheaply or aren't willing to do it. And that's why they're starting to talk about shared borrowing now, shared debt.
Yeah, absolutely. Thanks to Valerie Teitzel for bringing us that chart. That is it for Early Edition. More surveillance still ahead. They no doubt will bring you a focus on some of those IMF voices that we're hearing from this week. They'll also speak to Mohamed El-Erian, who writes for Bloomberg Opinion, of course, and advises Allianz. This is Bloomberg.